Hello, everyone. This is Anton Madley with Peak Market Watch. We speak with market leaders in commercial real estate and related services who have a close pulse on the current market environment. My co host today is Ben Saddles, co founder of Disrupt Equity. And we are honored to welcome Anna Kelley, who is also known as the REI mom or real estate mom. Anna has been active in real estate as a real estate investor in single family and multifamily for many years. Welcome, Anna.
It's so good to be here with y'all two to get today.
Yeah, definitely. So, Anna, why don't you give our listeners a little bit of a brief background about yourself and where you stand today?
Awesome. Yeah. So thanks again for having me. As you mentioned, I've been investing in real estate for a very long time. I bought my first real estate property in late 1998. And at that time, I really wasn't thinking about real estate beyond just a nice investment to have, something to kind of have on the side. Back in 1998, I was with Bank of America in private banking. And so I basically was in the institutional investment world. And I bought in at that time to the idea that you buy stocks, bonds, mutual funds, 401ks. And one day when you're 65, you could retire, with $1 million and hope to live on $40,000 a year. I didn't think that sounded really good. And I wanted to be able to do it a little more quickly. So I met some clients of mine who had real estate, and it really piqued my interest that I need to start at least adding some real estate to my portfolio. So bought a condo, bought a house. We flipped a house when I had my first child 19 years ago when he was 3 months old because I wanted to get home with my children. And I had at that point moved to AIG. And so I was in the corporate world where we developed products for ultra high net worth individuals, banks, and institutions, primarily hedge fund, private placement wrapped insurance. But I knew that I needed to figure out a way to replace my six-figure income so that I could stay home with my kids. So I have four children. And my first thought was, I will become an entrepreneur. And so my husband and I started a chiropractic business in Pennsylvania in 2007. And at that point, we bought a commercial building that had office space on the bottom, some tenants on the top, some garages, a mixed use. And we thought, well, that's a nice way to kind of cover some of the costs of doing business. And then we house hacked a 4 unit because I said it's not too smart to move across the country, start a new business, not know if it's going to succeed, and have a house. And that really piqued our interest to say, wow, it's really nice to have a little extra income coming in. Maybe we'll buy some more properties. And, when I leave AIG because his business was going to do great, we would just slowly but surely buy property. Long story short, 2008 and 2009 happened, and I worked for AIG. And I had this aha moment. The biggest company in the world, one of them, was no longer secure. My 401k was wiped out and no longer secure. And my husband's new business was not doing well either. So the only thing that was going well was that my tenants were still paying rent. They were paying rent consistently through a deep recession. And I said, aha, this is something people need. And let's buy more of it. It's on sale. It's dirt cheap. This is the way that we're going to create financial freedom. So from that point on, I created a plan to buy enough small multifamily units to be able to replace my income. And I retired at AIG 4 years ago after accumulating about 100 units in my personal portfolio. And then from there, did joint ventures of a couple hundred units, and then started syndicating about 4 years ago. And now I've done about 300 million in multifamily syndications.
Yeah, a great story. So AIG obviously was in the middle of that storm, right,
Yes.
in 2008 and 9. So many probably do not know who AIG is, but they were one of the major firms that suffered from that single family collapse in 2007, late 2007, all the way to 2012.
Yes.
So it's really interesting. You worked for them, but at the same time, it's that your real estate investments, including single family, actually still helped you to build your basis for where you are today. Right?
Absolutely. Because one of the things that I realized working in the institutional world is if you have a lot of money, I could tell you what to do with it to make more money, right? We're taught to take people's money and invest it and make really strong returns through retail investments. Real estate is something your financial advisor is not taught much about. So they're not going to tell you to park it in real estate. But I realized that, wow, if I had a lot of money, I know what to do with it. But I was in a position where I didn't have a lot of money. We sold everything in Houston when we moved to Pennsylvania. We started a business with a ton of debt. And essentially, we were supporting my husband's new business and our children on my salary at AIG. And I thought this is going to take decades to create, retirement wealth. I knew that I just didn't have, $500,000 to put in the stock market or in a private placement to then create wealth. I had to do it the slow, methodical way. And the beauty of real estate is you can get started without any money and create tremendous wealth. And so what would have taken me, 40 years to maybe make $1 million in the stock market, I was really able to create an 8-figure net worth in about a decade, starting with nothing through real estate. So I knew that I had to shift that and I had to be thinking differently than all of my training taught me if I wanted to take control of my wealth and really grow it in a faster way than what traditional resources allowed me to do.
And I was going to ask, Anna, I mean, obviously, we're in a recession right now, or, we're going to be in one. Everybody's got their own opinions on where we're at in the cycle, I guess.
Yeah.
Obviously you were investing through that time. And what I guess, where are you at in terms of the similarities or maybe the differences between now versus the great financial crisis that we had, and just kind of
Yeah.
a lot of, I guess, doom and gloom in the news.
Hmm.
And you have to kind of make your way through a lot of that. And if you're a new investor that might be tuning in and, is this the right time to be investing? I mean, I guess just kind of your thoughts on where we're at in the cycle and is it still a good time to get into real estate?
Sure. Yeah, let's break that up to a couple chunks because we could talk for hours about it, right? All of us are kind of like economic junkies and love what we do. But I think at a high level, it's really important to understand that if you want to grow true wealth in real estate that you can keep, that's going to last for the long term, you've got to think about investing from a long-term perspective. If you're trying to get in and buy a house and flip it, this might be a really dangerous time to do that if you're trying to, get in and out of any kind of asset in a year or two. But what I learned through investing, through 2008 and through the pandemic and where we are now is that you're going to have blips in the economy. You're going to have ups and downs in the cycle. Sometimes it's obvious that the signs are showing that we're still in an expansionary cycle where things are going to continue to grow. And then we start seeing warning signs that we might hit a peak, that the real estate and economic cycle is starting to head down. And we've been seeing a lot of those warning signs, but it could be, 3 months from then that things really tank, and it could be 3 years. So I've learned over time that we watch the signs and we can kind of tell where we're headed. And we need to make adjustments to things like what type of debt do we take on for a property based on where we think we're going? Or do we think that we're overpaying for an asset that might be worth less a year from now than it is today? So we want to look at those things. And generally speaking, I believe we've ended, the longest expansion period we've had since Abraham Lincoln was in office, and we're heading toward recession if we're not already there. So those are the things that I'm thinking about: is be really wise with your debt. Anything you buy, anticipate a longer hold period than what you might have over the last couple of years, so that you can weather changes in the economy that might make your values or your interest rates go up and down. But there's good deals to be found in every single market cycle. So just because I think we're heading into a recession doesn't mean I'm saying let's no longer buy. Because the fact of the matter is, when you look at real estate cycles, the biggest opportunity to make the greatest amount of wealth is when everyone else is afraid and running away at the bottom. And you're saying, this is when I'm going to pick up properties at such a great basis. And after a recession, when rates come down, a great basis and low interest rates, that's when you want to scoop up as many properties as you can that you plan to hold long term. And then you ride them up until the values have gone up significantly, your income has gone up significantly. So I think I'll stop there and let you ask questions.
So I guess, so there's a lot of people are like, oh, well, I'm gonna sit on cash and wait for that time that you're saying, which is going to time the market, perfectly, like everybody would love to
Mhm.
be able to do, right? What's your thoughts on, and again, this is a lot of people that I would probably say are maybe newer to the market or maybe got really, really burned during the
Yeah,
great financial crisis. And they're spooked now because obviously things are, teetering a little bit, and
sure.
I'm hearing a lot of that. Well, I'm just going to hold on to my cash. I'm holding on to cash. And I have an opinion of why that's probably not the right way to do it. But, what's your thoughts
Yeah.
just for our viewers that might be having that same kind of hesitation of jumping into something? Doesn't even have to be real estate, just any investments.
Yeah, absolutely. I think it's wise to be cautious, Ben, and I know you would say the same thing, but at
Yeah.
the same time, it's really difficult to time a market perfectly. As we mentioned, I thought we were heading into a recession early 2019 because it was a blip. There was a manufacturing recession that's actually technical, but it wasn't widespread. And then we had some, issues going on with the Fed and raising rates and a little bit of a market tantrum, and they brought us right back out of it. And so I sold some things in late 2018 thinking in early 2019 we might be heading to a recession, and here we are. It's 4 years later before we are. So the problem is, if you say I'm not going to do anything, it could be years before you do something, and there could be a very small window of opportunity that's really opportunistic that you miss. Because recessions generally, if you look through all of history since we've been tracking it, an average recession lasts 10 months. So it's not a significant amount of time. And that's 10 months from the time it was, from the time it started to the end. And often the NBER that dates recessions doesn't even do it till 6 months after we've started. So it's a very short window. And it's not the only window with which to make money. You can make money at any time in the cycle if you structure your deals properly. So I don't like to say, sit on the cash and wait for the timing and it's going to crash. And if you wait for 6 months, you're going to get great deals. The other reason is because different asset classes perform differently. And the thing we're talking about multifamily specifically here, the thing about multifamily is it is extremely recession resilient. And so those owners who own properties that don't have debt that's making them have to get out of them in the next couple of years, and maybe that's a next, topic, but if they have good debt and they're cash flowing, they have absolutely no reason to sell me their asset at a really great basis. And so we could be in a deep recession and sellers can hold on to properties because they are so recession resilient. And we may never see a major bottom in multifamily like a lot of people are hoping, because they simply are financed well enough that a lot of really good assets simply don't come on the market and give us that, huge win in terms of stealing the property based on the basis at the bottom.
Yeah, and I really obviously, just for our viewers' sake, I mean, we love multifamily for various reasons. The other reason I love it too, right? Being that inflation hedge is
Yes.
that you're not locked into 3, 5, 7, 10-year leases like you might be in the commercial side.
Right.
You can re-rack your rents every 6 to 12 months in multifamily. So you can kind of keep up with some of those inflationary challenges that we have,
Right.
by just increasing rents, right?
Absolutely.
And so that's one of the reasons. So you combine that with fixed rate debt, and you've got a very powerful investing tool,
Absolutely.
even in a little bit of a, weird slowdown of a market that we kind of find ourselves in.
Right. And it's one reason that really multifamily generally is more resilient in terms of its values than, a single family home in a market that perhaps might have a real deceleration in values in certain cities. But even that, it's very different from 2008 in that in 2008, we had this mass supply and we had a lot of variable debt that was coming up for renewal that people couldn't get out of. Now we have a tight supply because no one's going to sell their house when you think about single family unless they absolutely have to, because they can't downsize and have a lower payment because prices are up and rates are up. And so I don't know that you're going to have this huge opportunity of really cheap prices in this next year or so like we saw in 2008 or 2009. Those that are listed, I believe, are more motivated. So they're more likely to be able to, to negotiate the price. But I just don't see it being quite the bloodbath in values in either single family or multifamily that we had in 2008 and 2009.
And to kind of touch on one thing, just to kind of drive this home, right?
Sure.
The supply and demand imbalance in housing in general, right?
Mhm.
Whether it be single family, whether it be multi, we need more housing. right? And at least in the markets that we all invest in, right? Think the Sun Belt, think
Yes.
up into the Carolinas, Florida, all of those great markets, right? There's a ton of people moving there. And yeah, they might have a lot of housing startage, and they might be building a lot, but they're not building enough.
Right.
I saw something that, like, just here in Texas, where we're located at, that there's a $4 million, or not $4 million, 4 million, units or housing difference between what the demand is going to be versus what the supply is going to have. And so it's
Absolutely.
quite a bit, you
It
know.
is.
So that's another reason why, multifamily and really just real estate in general, I think is going to be a great investment over the next 10 or 20 years.
Yeah,
'Cause
and I think a couple things you said there. One thing that's really important, especially for newer listeners and newer investors to understand, is that we talk in these general terms, but real estate is extremely local.
yes.
It's very, very different depending on where you are in the country. And I own assets, I think, in 6 different states right now. And primarily, I invest in Class A to B assets in A or B areas that are very strong in terms of great jobs, a lot of industry diversity, higher wages, lower cost of living, great schools, great hospital systems, low crime. And those are the kind of areas that are going to do very, very well during a recession, even if there is a downturn. It also means that those properties aren't going to go on sale, a fire sale, the way maybe some Class C rougher properties might be, or properties that are in smaller towns or dying towns. And so your mileage will vary significantly based on where you invest. And so the market in which you're investing is really the most important factor to your personal success as an investor, more so than the macroeconomics of what's going on in the entire country. The macro matters, it impacts the micro, but where you invest makes a tremendous difference. And you've really got to understand, is there enough supply? Is there too much supply? Is the demand continuing? And markets like Texas, where we invest, we have so much inflow. Second year in a row, the FedEx, UPS has more stuff going on, more businesses coming to Texas, more U-Haul transfers going to Texas. And so, the jobs and the people just continue to come in those bigger cities, and there's just not enough housing. So that bodes very well for us as multifamily investors.
Absolutely.
Yeah. So you made a great point there, right? Real estate is local, right? And
Yes.
I think when we look at the overall news, and obviously that's what everyone is pushing when it comes to clicks. We always want negative news in the headlines because that creates views, right?
Yes.
And to be fair, right, when we look at 2007, 2008, 9, and 10, all the way to 12, multifamily, some markets suffered very significantly,
Yes.
where values dropped by 30 to 40%. However, there were other markets that didn't really drop that much. And as what Ben was referring to, as long as you have fixed rate loans for 3 years, 5 years, or even a bridge loan that is longer, and you can survive that immediate needs to sell or refinance, everyone came out of it perfectly fine because the cash flow was supporting them throughout that period. And I think that is always what is getting lost a little bit in all
Yes.
these discussions, that yes, we probably will see some multifamily markets as single family markets where values may drop 30%, but that is not applicable to every other market, right? And
Right.
at the end, it's really employment growth is key to population growth in any single market, and that's where the good investors really separate from the bad investors who just chase whatever the last year or two the numbers look like, but rather looking where the actual growth is coming over the next few years.
Yeah, absolutely. And I think something that's really important for people to understand. I know a lot of great multifamily syndicators, but they just don't have a history of ever living through any kind of downturn, right? So they seem to be a little overly optimistic that this is a blip, it'll be a V-shaped recovery, values never go down. I know others that have been investing a very, very long time that say, I think it's going to get pretty rough, and they're a little more worried. And so I kind of have this middle ground where I've done a lot. What I learned from 2009, my biggest lesson was that I thought I knew a lot because I was at Bank of America. I was at AIG, the division that ended up almost, collapsing the economy. We sold credit default swaps, right? And I had no idea. I was completely blindsided by the crisis. And so what I learned was that you can know a lot about your particular niche or your particular type of investment. But if you don't kind of watch what's happening at the economy as a whole and look back at history to see what is resilient in recessions, what isn't, what kind of lessons can we learn? Those are the people that end up being blindsided, ignoring all the tough news and only listening to positive news. So there's a danger in both of that. But one thing I learned, I started to become a student of the economy. So I started to really watch what's happening at a macro level that could impact rates, that could impact the credit markets, the debt markets, and asset values. And generally speaking, specific to multifamily Class A and Class A to B markets. And I'm talking very strong, large cities with great jobs, great inflows of people. Values typically actually come down during a recession. So cap rates on Class C, older properties or properties in tertiary markets, they're the ones that the cap rates start really rising rather quickly and have much bigger drops in values. But these institutional quality assets in large cities, they become a flight to safety asset. So when people don't want to be in the stock market or the bond market or anything else and they're afraid, they sell out of that and they move into Class A and Class B multifamily in these strong markets. And that actually keeps values up. So I'm not as worried about Class A and B stuff in really strong cities like where we invest, Houston and Dallas and Austin, for example. But if you chased yield and you went, I like to pick on Oklahoma City, so I hope y'all don't own stuff there. But, if you were like, we can't get yield in Houston and Dallas, so let's go buy a Class C property in a Class C market in Oklahoma City because we think the cap rates are better. Those are the markets that are really going to struggle now because they just don't have the underlying economic strength to weather a recession where people are going to move in for jobs. They're going to move out and go to Texas looking for jobs. So the type of asset you buy and where you buy it, it's extremely critical. And that you understand if you're buying A to B stuff, you're more protected and resilient in a downturn. If you're mostly buying C class, D class assets, those are the people that need to worry a little more and think about, some different debt and liquidity options.
100% agreed. One other note I wanted to kind of mention, because I recently saw Mark Dutzer, who's Texas A&M economist, and everybody's heard of this guy or seen him speak. So first time I'd ever seen him. It was very, very interesting. But he kind of talked about, some of the headwinds that we have and, how the Fed is reacting to some of these things, right? And I think two things, because this is obviously a market watch show, right? Two things to kind of look at is obviously the supply chain and our relationship with China matters, right? Because at the end of the day, right, he described them as not a trading partner, but almost a subcontractor of the United States, where they produce things for us and they send them to us. They haven't been a very good subcontractor of ours, right? And so we have to kind of understand, the balancing act that we have with China, because obviously we still get a lot of our goods from them, and how that could potentially affect the supply chain and pricing and all of that too. That was one of his big things. The other thing that he also was kind of, really, really focusing on was the wage inflation that we have going on, right? You have so many open positions versus so many people that are either on the sidelines or completely out of the market, right? I think he said we had like 10 million openings and there was only like 5 million people looking.
Yeah.
So on top of that, you also have what really the Feds, they have everything looks like a nail to the Fed when you got a hammer, right? And so all they're really going to try to do is throw water on a hot economy and essentially create unemployment, right? And once you have the unemployment, all of these things will you'll essentially just destroy demand, right? For things. And then they can swoop in at some point and they can start stimulating the economy by lowering interest rates,
Right.
right? So what people don't realize is that that's what they're trying to do right now. And so
Yes.
I think that this kind of a fine line that they're doing, but you've got this screaming in one metric, you got the screaming hot, 10 million job openings, and the other side of the coin is they're trying to essentially slow down the economy and create, more unemployment,
Yes.
so destroy demand. And so it's a very interesting, if it's a recession, I'm not going to call it is. And I think it's just a very interesting one. And I think we just got, I don't know, I'm sure the Fed's probably coming out here very shortly on what its rate hike's going to be. And who knows
Right.
what it is. Maybe it's already come out. I don't know. Anton probably closer to it than I am, but
Yeah.
that's happening today. And then, on top of that, we just saw the GDP. What was that at 2.9? So, it's the oddest recession that we've ever been in if we're in one.
Yeah,
Right.
it's very strange. I agree with you.
And
And
then
one of the
again,
things that I've been
and
watching, just going back and listening, to history is what has the Fed done in prior periods? But and the economists love to talk about that on the news and the talking heads, like, well, in the 1970s, they had to get rates above, inflation to bring it down, or this, that, and the other. But this time that we're living in, to your point, is so different than anything we've experienced. And our economy is significantly more complex and more interrelated globally to countries like China, and others. So that unfortunately, there's so many things that can pop that can make our expansion go into a much deeper recession than what people think. But there's a lot of strong things about the United States that also might keep the recession from being bad, unless there's some kind of outside force or outside factor that really pops the bubble, such as an escalation, in the war with Russia and Ukraine, if that ends up, becoming larger, or if China goes after Taiwan, or, aligns forces. So there's so many factors that make it really complicated. But I think, to your point, when people say we're not going to have a recession, I say we're either there or we're just about there. And so I've learned to kind of track all of these different data points, because it's interesting. Certain economists really only focus on a few key data points, and then others focus on only a key others. And what the economy looks at, I look at what the economists at the NBER look at, and the Fed. And essentially they're looking at the components of core inflation. And so that's core goods, core services, which is where most of the wages are. And then we've got energy and food. Well, it's interesting because energy and food skyrocketed, in part because of, Russia going after Ukraine and all the supply chain issues. Those have come down. And core goods, the things that we buy that are not necessities necessarily, but a lot of basically wants instead of needs, that inflation has actually come down quite a bit as well. So these economists that say inflation's already down, the Fed can stop, they're going to lower rates, and we're going to be great. They're not looking at the key indicator of the Fed, which is wages, and that's in core services. And to your point, there are so many open jobs that are lower in jobs, like blue collar jobs, working in restaurants and gas stations, et cetera, where the wages are up significantly, but there's openings in large, more high dollar jobs where there's not enough workers matched to those things. So the Fed wants to bring down core services, they do, and wages, and they only do that by putting enough pressure on the economy with the continued rising rates that companies start to lay off, companies start to close those jobs, and basically wages come down. And they want to do that without making unemployment so high. And they don't have fine precision tools like we want them to. They say, let's change the rate, and it's going to take 6 to 9 months to trickle through the economy to see if we're there. So when Powell says, I don't know if we're going to go into recession, he knows that every indicator is now recessionary, with the exception of wages, and that's the last thing that they need to hit the hammer on the hammer on the nail, as you said, in order to put us into enough of a recession and a slowing growth that they can say inflation is dead, they can ease off. And if they go too far, we'll have a deeper recession.
Yeah, and just for everybody's sake, the things that he kind of obviously he got his crystal ball out, and he was saying that they're going to try to kill 1.5 million more jobs which I forgot exactly what the percentage of unemployment would be in the United States at that point. The other data point that I thought was kind of interesting, obviously, again, I'm a little bit biased here being that I'm in Houston, is that, looking back, whatever the national unemployment rate was, typically Texas is half of that. And then whenever on the flip side, whenever there's growth, Texas is usually 2x better in most metrics than the national average.
Yeah.
So,
and GDP as well. GDP in Texas is stronger than GDP nationwide. And so it's another reason.
And I think it goes back to your point, right? Which is, you really need to understand the local market. I mean, it's nice. And I think what I love about your posts on Facebook, and everybody should be following Anna, it's very thoughtful, and you do kind of bring up some of these macro things, that people need as syndicators. You can't have your horse blinders on, right? Now obviously real estate's local, we get all of that, right? But some of these things affect the debt and equity markets that we have to structure our deals properly, right? And so you can't be completely blind to what might be happening at the macro level, because that could ultimately end up affecting, can you buy a deal? Is there even debt to put on the deal?
Right.
And so you need to at least be a student of some of these things and understand that. And then how does that affect my local play?
Absolutely.
And so it's important for people to take that into consideration.
Yeah, for sure. Thank you for that. I think the biggest thing is we've been very spoiled for about 15 years, right? With an increasing market where we didn't have to worry about, are interest rates going to stay high for so long that it impacts my cap rates and the values of my property, that it might cause my debt to reset and not be able to cover the new debt payments. We haven't had to think through those things. And so now we're seeing something that seems so foreign and impossible, because it hasn't happened since the 1970s. So it's important to kind of understand where we are and at least watch the signs of, what is the Fed saying? What are they doing? And the biggest takeaway is, if you have to buy something that you need to get out of in the next year or two, when we don't know where rates will be for sure, and we don't know where cap rates will be, you've got to steal it. Meaning you've got to get a great basis. You've got to get a great deal, no more average or okay deals. You've got to be a great operator, but you got to get a really good basis on the property. And you have to work with guys like Anton and be able to say, what's the best debt structure that can go either way, that can benefit me, whether I end up having to hold this thing for, 2 or 3 or 4 or 5 years, and what are my options? And so it's all about, if we understand where things could go either way, right? Either more inflation or more recession, more or less LTV, because the credit markets always tighten up. And this is the tightest tightening I've ever seen of a credit market, even through the pandemic, on the debt side. And so I've got to work a lot harder, get a lot better deals, and have debt where I can sleep at night knowing that I've got an exit plan, regardless of where cap rates go. Our operations are going to get the cash up, the NOI up high enough to kind of absorb any ups and downs in value. And we've got debt that we can manipulate or change down the road. So if you don't understand the things that impact that, you can be in a lot of danger if you do deals that you think are good that are not. So it's important to understand all of these inputs and risks when you decide what deals you're going to do.
And I think one thing I want to just touch on real quick was the operational component, because we're talking about the market a lot, but obviously I've seen where a bad deal can go good with the right operator, and vice versa, yes. Right? A really great deal that somebody buys and their bad operator can turn it to what. And so I think this is going to be the decade where we're not going to get the boost from just the market appreciation. Yeah, there's probably going to be some, especially in these markets that we've talked about, right? But really, where the difference in the operators is going to come in is how well they get, how well did they underwrite the deal and got it at a good basis is first and foremost, right? You make money when you buy. But then really it's the operational component, right? Making sure you're dialing in your asset management, your property management, your construction management, and getting the right deals and operating them very, very tightly, because in some of these markets, you're just not going to get the boost. I mean, I won't name anybody's name, but in DFW, there was a lot of people that bought and they didn't know what they were doing, and they probably didn't buy in the right part of town. Not all of DFW is great, even though it's a great
Right.
market, and they were completely bailed out by the market.
Right.
And don't get me wrong, it's nice to be lucky. It's better to be lucky than good sometimes.
Right.
But I think the point that I'm trying to make is this decade, you're not going to get that benefit. So it's
Right.
more important than ever that you have that dialed in. You buy it right and you operate it efficiently, because you're just not going to get the benefit of, the market appreciation like we got in the last decade.
I agree 100%, especially because now we're at the bottom. And so people that are buying, for appreciation, the likelihood is that it's going to be at least flat for a little bit, other than forced appreciation, which we do through operations, to your
Yep.
point. So, we're at the bottom of a cycle, and an average cycle from the point of a bottom to a top is 5.5 to 7 years. We had a much longer run at the top this last expansion than we typically do. But what that tells me is if I want to buy today, and I'm hoping for real appreciation, I've got to expect that, let's say the recession lasts 10 months and we've got 18 months of recovery, which is average. We're on the other side of almost 3 years before we really start to have growth from just the recovery period. You're looking at 3 years out. And so you've got to expect that you're going to force appreciation by being a really good operator, to Ben's point. And then if you want that excess, my cap rates are just going to continue to, come down because of what the market's doing or rents going up. It's really going to take a couple of years. And so you have to have the long-term horizon, and you have to be a really great operator. And if you're investing passively, invest with operators who have experience, who have lived through the pandemic and maybe, 2008, that can say, if this happens, we have the wherewithal to have resources and ideas to where we can continue to maximize income, cut expenses in unique ways, so that even if cap rates don't do what we want, we can make up for that in the operations and the NOI side. But it's a lot harder to do than it is, to say you're going to do it.
Well, and I think you touched on one thing too that I guess would be my trifecta, right? Buy it right, operate it right, but cash reserves right now. I mean, I'm not
Yes.
going to say cash is king because that's kind of a weird, like, broad statement, but having cash reserves right now, in your operations is just so important. We're seeing, I mean, we have a third party property management company, just from management, and we see a lot of clients that are just getting walloped right now because their debt payments have gone up 50, 100, sometimes even more than that a month, and they're having to now float the property because they're essentially just upside down.
Right.
And that happened in a matter of less than a year. So, just be careful out there when people are buying, and make sure that you have the right level of reserves too, because like Anna you had mentioned, right? You might have to ride it out for another few years, folks.
Right.
So, make sure you got ample reserves, and you structure your deals right, and you operate them tightly, because you probably got to ride it out for a little while longer.
And that kind of goes back to Anton's first point. Are you holding cash, or are you kind of waiting? And I think that for any of us that have assets, it's really important that we not think that this is a market that's just going to keep going up, 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 up. So let me use every penny I have and invest it all, and then just hope the market does well. I'm holding more cash than I ever have. Some of that's for reserves. Some of it's for opportunity. But the biggest chunk is I want reserves in case, inflation does come back and get higher again, and rates are higher for longer. And I've got to, hold an asset with a much higher debt service payment. So I'm holding more cash than I ever did before I was really aggressive, until we lived through the pandemic. And if I hadn't had all the cash reserves that I did during the pandemic, we wouldn't have made it when, for 3 or 4 months, some of our tenants couldn't pay. So having cash is critical. I agree. It's probably one of the 3 most important things. And then if you have enough to invest outside of that cash, then you can decide, where can I find great deals, partner with great operators that I can hold for the long term, that are going to help me to really preserve what I'm investing, as well as grow it over the long term.
Yeah, all great points. I would say certainly having cash also for opportunities is the right way, right? Other than just operational reserves. Even if we believe that the overall multifamily market is not coming down significantly price-wise, there is a segment that definitely is going to suffer, which
Yes.
are properties that were bought by people that didn't know what they were doing, and that creates opportunity, right? So there is
Yes.
no doubt about that, that there will be great opportunities for buyers that know what they are doing. Um, I think what we have seen certainly, and Ben touched on that, like that market builds a lot of buyers out. That definitely is out the window now, right? And I call them fake value add properties,
Mhm.
right? So we have seen so many deals where people just came up with the argument that these are value add properties when they were not truly value add properties.
Right.
There is no reason not to buy a true value add property in any market if it's truly value add. But if it's just more kind of where someone tries to make the numbers work and then calls it value add, that's definitely not the right way to buy. And that's also not the right way for passive investors who invest with in these type of deals, right?
Right.
Yeah.
And I think the lenders are in some ways protecting, newer or a little more aggressive syndicators right now, because it is harder to get loans on these properties. And so even, Ben and I who are doing bigger deals, and we've got years of experience and net worth and liquidity and all of that, it's still tough to get the same type of the same level of financing in terms of your capital stack. So lenders are, offering a much lower LTV, having to pull in private equity money that wants higher returns than what your loan is, and then having to bring in a lot more from investors who still expect those, high returns. It's much more expensive now to operate those properties, just because we have to come up with so much more cash from ourselves, equity investors, and debt. And so the good thing is, by lenders pulling back, it keeps people honest, and they're really undercutting our underwriting and going, you think you're conservative, we're going to be even more conservative. So I'm thankful that it does protect those. It also weeds out a lot of those operators who really shouldn't be, doing this at this time with investor money. And those of us that can do value add deals, generally speaking, if we're getting the loans and we have a lot of experience, we're going to be able to do better than, what people did over the last couple of years that had easy money.
Yes, absolutely. I would say we solely have had roughly a year and a half, maybe 2 years of very loose credit, right?
Yeah.
So from the late 2020s, 2020, all the way to early 2022, where it was just too easy to get a massive amount of leverage for these so-called fake value-add properties. And I think these are ultimately the deals where also the opportunities will arise for guys like you, Anna and Ben, right, who know how to analyze a deal and then pick up some of these opportunities.
Yeah.
Absolutely. I'm very opportunistic and very, excited to continue to buy, even though there's these headwinds, as you say. We just have to kind of take those into account in the risk and the price that we pay. But I think there will be a lot of operators that really need people like us to come in and say, okay, we're going to get you out of this before you lose the property, and then be able to, hold those and tweak them and still make great returns for our investors.
Yeah, I think the back half of 2023 is going to be an awesome opportunity, because you're going to have a lot of people that can stroke that check for a little while, but they're going to start running out of money, and then they're
Right.
going to start looking for, okay, what's my exit strategy? Because I'm not going to go into the poorhouse trying to support this property. I'm just going to offload it.
Yeah.
And I don't, and to some extent, I get where they're coming from, but they put themselves in that situation, unfortunately, by not having enough capital reserves to really, effectively operate the property in a downturn. People, they always look at it in the best possible light. Like,
Right.
okay, I only need these reserves if everything's humming and everything looks good, right? But you really
Mhm.
need to be, the reserves are really there for when things hit the fan.
Yeah.
When the bad times are happening, and what does that potentially look like? So
And I think we're in an era where we do need to start making that the norm rather than the
it does need to
exception.
be a
So
norm.
again, everyone looked back 10 years and said, oh, it's rare that we've needed cash reserves only during COVID. I think during this next 10 years, if you look at the demographics and you look at the economics on a macro basis and a global basis, there's a lot more headwinds that could cause some economic pain for the United States over a longer period of time than just a technical recession. And so, things like insurance going up, 30, 40%. They could go up even more. Energy costs. I think there's going to be some deglobalization of energy and certain things that get brought back onshore, that's going to drive up cost until that R&D and that investment period comes out. I think things are going to generally be more expensive, and we've got to be able to really factor those things in instead of 2% cost increases every year. We have to think we might be in for longer term, higher costs, higher expenses. And so we need to be able to have reserves at all times in case, something else major happens that we didn't see coming. So that's what I really learned through the pandemic and, through this mass inflation and really the most rapid increase in interest rates that I've ever seen is cash reserves, great deals only at a great basis, great teams. And, if you're not doing that and in a great market, then you probably shouldn't be investing in multifamily.
Yeah, and one thing about reserves too, right? People are like, "Oh, I got to raise letters. It's gonna water down my returns." Yeah, it will, but it doesn't water down that much. And let's be honest, if that makes your deal that bad, then you're probably pretty tight in the first place, right? But I mean, I guess I leave our listeners with this one last statement on this, right? If it lets you sleep better at night, if it allows your investors to sleep better at night, having an additional $1 million in the bank, why wouldn't you want to do it? Why put yourself through the stress? Well, put your family through the stress of having to stroke that check, or having to do a cash call and your investors be sweating it now.
Absolutely.
I mean, that's kind of how I look at it. And so I commend you for saying that, because I think we need to normalize having the right amount of reserves. This is like, let's pencil in a couple $100,000, and say that we've got ample reserves. I just don't think that that's just not gonna cut it in the next 5 to 10 years.
Yeah. Absolutely.
Yeah, absolutely.
And all investments are about risk and reward, right? And so you go up that ladder where the more risk you take, the higher the returns, but you're getting riskier assets. So if you don't have reserves, you're upping that risk pretty substantially. Your returns better be a whole lot better. But on paper, it's easy to say this is a 20% return and this is how much risk. But as soon as you don't have cash, it's not just a matter of your return is now 18 instead of 20. It could be you lose the property and you lose everything.
Yes.
So it's a preservation of capital, play more than anything. First is don't lose money. And during times of economic volatility, that has to be your number one. So I invest passively in a lot of deals as well, other than the ones I operate. And I would invest 10 times faster and 10 times more money in a deal that had a couple $1 million in reserves and paid me 15% versus one that was really slim and said 20, because the 20 means I could lose it all. And the millions mean I probably won't.
Yes. Risk-adjusted returns is an important statement that people should get from this podcast. I get it.
Absolutely. Yes. And I think a lot of syndicators as well as passive investors really need to look at how institutional investors have been investing in commercial real estate and particularly multifamily, right? And we already see it. You mentioned, Anna, that lenders are now more restrictive in terms of underwriting and leverage. And that helps also to bring down the leverage to a level that has been historically at the institutional level, right? Institutions have leveraged at 50 to 65 max, whereas syndicators had tended, at least in the past, to go 80% plus, and that is a higher risk. It's just a normal situation that everyone has accepted. And to Ben's point, right, that risk-adjusted return, unfortunately, a lot of investors in syndications have not really understood that risk-adjusted return element. And hopefully, as we go along, they have a better understanding of that.
Yes.
They'll learn the hard way in some cases, unfortunately. I hate to say it, but it'll be an important term that people will hopefully get educated on.
Absolutely.
Yeah. All right. So we have had a great discussion here. We probably could go on for hours, right? It's always great to have you on, Anna. You're a wealth of knowledge. We have been watching you in various ways, how you operated your investments and what you have looked at and what you have done. So it's always great to to listen to you. And for everyone out there, please follow Anna. Right, so she is a mother first and a real estate investor second, to support her family and her investors. So it's worthwhile to follow her. So now, Anna, how can we reach you and follow you?
Great. Thank you. First, it's been my pleasure to be your guest. It's always good to see y'all and spend time with y'all. You can follow me on social media at Anna Kelley, REI Mom, and my website is greaterpurposecapital.com.
Okay, great. Thanks again, Anna, for being on with us today.
Thank you.
Thanks, Hannah.
Thanks, Ben.